Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today on Cable TV 10 in New Bern and 94.1 FM WNBU. We hope that everyone survived Hurricane Irene well, all the way from where it made landfall down in Morehead City area, all the way up to Vermont and Maine. I understand they're having problems up there. We hope that our viewers and listeners made it through okay. So today we're just kind of catching up on a few topics. We talked a little bit in the first segment about Bill Gross and his colossal miscalculation on the U.S. Treasuries. If you missed it, visit us on the web, www.dlblain.com. There, about a week or so, we'll have an archived copy of the show, and you can listen in on what Bill Gross's colossal mistake was, the world's largest bond fund manager. Just goes to show you, A, not everyone's perfect, B, you cannot predict the markets, and C, if you're an individual investor out there, we advocate maintaining a well-diversified portfolio that, unlike Bill Gross, still includes U.S. Treasury bonds. Okay, let's move on to the next topic. For those of you regular listeners and viewers out there, you probably noticed I have somewhat very conservative economic viewpoint of the world and things like that. And I wanted to talk about this payroll tax cut that's been in the news. As you recall, a year or two ago, President Obama enacted a payroll tax cut, cutting the employee share of the payroll tax from 6.2% to 4.2%. And this was designed to stimulate the economy, inject some capital into the economy and give workers a break. Now they're proposing that this tax cut, or I use that term tax cut a little loosely, and I'll explain why in just a minute, but this temporary reduction in the payroll tax, they're talking about extending it. And a lot of conservative economic leaning folks, so try to keep the politics out of it. Most of the conservative political people are also the conservative economic people. But anyway, conservative economists out there are saying, whoa, no, let's not do this. Let's think about it a little bit. Let's see what the payroll tax cut actually did, if anything. Let's look at this. And what the data is showing is that, A, the payroll tax cut that was enacted really didn't do a whole lot of anything. The reduction, I think it was $110 billion is what they estimate workers kept and the Social Security Administration did not get, about $110 billion for this one-year reduction. And so in theory, this payroll tax would have a positive economic effect, both on the demand as well as the supply side, meaning people would have more money in their pocket, they would go out, spend more, as well as employers would have increasing sales and be able to hire more people. Well, unfortunately, and this is what the economy means, unfortunately this is not what happened. That it really did not do much of anything to stimulate hiring or spending. There's a couple of reasons. Number one, first and most obvious, the payroll tax reduction only helps people with jobs. And so what we're trying to do is stimulate the creation of jobs. And if you give a payroll tax to somebody that already has a job, that does not help stimulate employers to go out and hire people. Of note also, this cut from 6.2 to 4.2 was only on the employees, not the employers, the people hiring. So they gave a cut to the employees, A, who already had a job, and B, who don't hire anyone. So obviously this is not very stimulative to increase hiring. You need to give a cut to the people that have the jobs or that can hire people, and you need to do something to the economy to get people that don't have a job into a job. So that was the first thing. The tax cut only helps people with jobs. Second, the payroll tax cut helps many people that had no need for it and just put it in savings. Of the people that are out there working, yes, there are a lot of people that are hurting and need the extra money, but let's face it, a lot of people, the cut from 6.2 to 4.2 was just not enough to make any real difference, and they simply pocketed the difference. Not to point out any one political party, but let's go back to the tax rebates of 2001 and 2008, which were enacted by a different persuasion administration. I think you all know what I'm talking about. But what we saw with those tax rebates was that people are more inclined to save these temporary tax rebates than to have much of a stimulative effect. That when people perceive an increase in their income as temporary, they tend to save it and not to go out and spend it. And so that was a mistake that was made with the economic stimulus. I think it was $400 for a person, $800 for a couple, that really did not have a lot of stimulative effect either. So just to kind of recap, by the way, we're not done with this topic, so make sure you come back after the break. But we're coming up on a break here. So just to kind of recap, we're talking about some of the economic reasons why we don't feel like an extension of the payroll tax cut would be beneficial. The theory is there that it will be stimulative for both spending and job creation, but the reality is the first one didn't work. A couple of reasons were it only helps people with jobs. Number two was it helps people that may have no need for the cut. It's really a sort of a blanket thing. And third, we see that people perceive temporary cuts as non-permanent. So we're coming up on a second break, and we'll be right back after a few short messages.